Hey everyone, this is Mark McClune with Retail Investment Group. I'm joined by Stephen Davis and John Tobin, and today we have the opportunity to get on a conference call with Alignment Realty Capital, whose three partners are Gary Linhart, Jake Gallagher, and Ben Sachs. A few key points that we are going to go over are the uncertainty of the marketplace, some benefits relating to the stimulus package, and what the overall reaction is from lenders during this uncertain time. If you have any specific questions or comments, please feel free to reach out. Hope you enjoy the call and stay safe.
So we've come together to form Alignment Capital to provide different kinds of financing solutions to the triple net space in retail. And I'll let Jake and Ben talk a little as well. Go ahead, guys.
I've spent my career on the mortgage banking side of things, and something that Ben and I discovered as being a trend in the market was kind of a dislocation in the single tenant space. And we never really planned when we started this for kind of this black swan event to happen, but it's kind of played to our benefit a little bit, and excited to partner with Gary on this venture and think that we can come together and create a platform that's going to help operators of kind of smaller franchise units of kind of 1 to 50 units, all the way up to somebody like a Starbucks corporate to own the real estate, to finance their real estate, and we hope to create some solutions for them.
Just piggybacking off that, the company was really founded with the intent to provide operational capital to franchise operators by allowing them to capitalize on value they create with their real estate. And I think in light of all that's going on, I think that service will be very beneficial. As we'll get to later, I think one of the main problems in the market right now is just a lack of liquidity, and these operators need liquidity to fund their core operations and keep their employees coming to work. So I think there is a lot of opportunity now more than ever to provide this source of capital through either a direct loan on real estate or potentially a sale leaseback, where it makes sense to free up an asset on a balance sheet, provide this immediate capital to get over this hump and put money where it's needed most, which is in the pockets of the employees.
It may be an opportunity if there are landlords that have buildings that or tenants where their leases are coming up in a few years, and they might not be in a position now to or it could be even where the lease is coming up sooner to do some sort of renewal, where there's capital in the market that might facilitate a transaction in this current environment where that landlord might, they might want to get out at this point. So it can work sort of from the landlord perspective or from the tenant perspective, in terms of there's capital in the market to facilitate these transactions, and in regular times and also in this unusual time.
We definitely are in this boat together, and you raised a good point that people don't say, that with regards to a comparison of '08, which was definitely the fault of some, and this is a whole new world where we don't know what this looks like when we come out of it. I don't think we really like the looks of what it's going to look like, although there could be opportunities for those that just prepare and know that it will end at one point.
Just to add to that, we don't know what the world's going to look like. There are certain trends that were going on that will be exacerbated by or accelerated by what's happened, whether it's work from home type trends or takeout trends or dine home trends or things like that. So it'll be interesting to see what's permanent and what's not permanent. My personal view is we're social animals, and while this technology is great, it can't replace being in person with people. And I think the kind of retail where people can go to and socialize, I think ultimately will be fine. But it's going to be a rocky road throughout this process. And then it's a lot easier, unfortunately, to lay people off and quicker than it is to hire them. And so the pace of layoffs is probably going to be a lot more rapid than the pace of people getting rehired. And
Yeah.
so I think a lot of the financing that you're seeing coming, or the bills coming from the government, are really incentivizing businesses to keep employees on the payroll. And there'll be some loan forgiveness as a result of that. So hopefully the damage gets minimized.
Back to the question with regards to the conversations and letters that tenants are sending out and communicating with their landlords with regards to not paying rent, delaying rent, rent abatement, all the above. Gary, what are you guys seeing and your team seeing with regards to those types of letters, and how should they respond?
Yeah, well, they're definitely of all types, and I would say they're coming from tenants of all sizes, square footage sizes, as well as company balance sheet sizes. Everyone's being impacted by this, some more than others, but I think most companies are in a position to ask for some sort of a rent relief. Either I can't pay rent this month, or I need some sort of abatement. And landlords are kind of dealing with all of that right now. I think that there's sort of a chain here. It can be, there's conversations going on, and we'll talk about this, between the tenants and the landlords and the lenders. And some of the feedback that a landlord might give a tenant might tie to the kind of loan that it has, or the type of lender that it has, and what the requirements or covenants on those loans are as it relates to what a landlord can actually do. Uh, Jake and Ben will talk about that a little bit as well. So I think what the landlords are dealing with initially is figuring out what in fact their parameters are in what. So that's, and then I think from a landlord's perspective, I think this is there's a couple of different sort of perspectives and things that they're dealing with. There's obviously long-term relationships with tenants, and there's a sense of this incident, or the pandemic, that's different from let's say the downturn in 08. Is that was all kind of a result of people being too aggressive in the market and so on, and lenders, and there was a little bit of everyone had some fault. Whereas in this case, this is really a black swan environmental event that no one's really at fault. So there's a little bit of everyone being in the same boat to try to figure out how to work through this. So I think the lenders, one, they need to understand what they can do as it pertains to their loan. And then as it relates to the kind of response they might give to the tenant, one, they're going to want to understand how financially impacted the tenant truly is. Is the request a legitimate request? And asking for how the numbers have, how the revenue numbers for the store has been, is a completely legitimate request. Some of the lenders are going to require personal financial information from the from the tenants, in order to allow the landlord to give concessions. So I think if a landlord shouldn't be shy about requiring the tenant to open the kimono a little bit if they're going to start engaging in the conversations. And then in terms of the concessions that might be given, you're hearing things from free rent for a certain amount of time that might get amortized on to the end of a lease. You're hearing about half rent or so on, free rent. I think many landlords, particularly if a tenant has less than several years left on their lease, they're going to be much more willing to, or what I'm hearing is landlords are much more willing to give forbearance on rent, or concessions on rent, particularly if a good tenant is willing to exercise one of their extension options at this point in time. So there's a little, if you're asking for something, or if you're a landlord receiving some of these requests in a good way, what are kind of the concessions that you might want the trade-offs that you might want from the tenant.
So the stimulus package that came out, it's $2 trillion and it's going to be dispersed with, I believe it was 300 or 400 million for small businesses. Is that accurate?
Yeah, among that roughly 2 trillion, it was about 349 billion that's allocated specifically as loans to small businesses. And the number is 500 workers is what they consider a small business, which did, it was originally going to be a little bit lower, and they did increase that to account for the fact that a lot of franchises do, when you take into account store level employees, have more than 500 despite being a small business. These are loans that are accessible through local banks, through the SBA. And I am under the impression from what I've read that they convert to grants that don't have to be repaid when they're spent on items such as payroll, rent, and utilities. And as mentioned earlier, there is incentive to keep employment active in that the grants actually reduce if you cut back on your employees. So it really aligns the recipients of these loans to maintain their employment by making them go away if they don't. And from what I've read on commentary from franchise operators and people in that sphere, it is being viewed as a pretty big win. I think previously in the last recession, there was a tremendous amount of financial aid going to the larger corporations, which gave a little bit of kind of mixed feedback because it was ironically the banks that many people blamed for the recession, and that's the groups that got the money. In this case, I think there was a lot of scrutiny to make sure that the funds were distributed not just to these larger companies, the banks and the Boeings of the world, but also to small business. And I think the government was fairly successful in allocating a material amount of capital to make sure that the mom and pop and larger, but still small businesses are kept afloat.
Yeah, that's an excellent point for sure. I haven't thought of it like that. What do you think is the path to recovery for this? I mean, I know we're still in the infancy stages of everything going on, but you know, everybody wants to see the light at the end of the tunnel, and you know, when does that light pop up, and what do you guys see as the next few steps?
Well, I think the positives from this week versus last week, last week it felt like kind of the credit markets were completely melting. And if you look at any kind of mortgage REITs or REIT preferred stock or the triple net REITs, there's been a tremendous recovery so far. The caution in the wind is most bear markets have kind of a double bottom. But once again, this is such a unique situation that it's possible that that doesn't happen. I think a lot is going to depend on this flattening of the curve and whether it comes back in the fall like the Spanish flu did with a much more lethal strain. And so if you listen to the virologists and the medical community, they want to be very, very conservative. And as the business people would think almost draconian and locking everything down. I think the longer that happens, the more difficult it is on the small businesses. So I think there's going to be some tension over the coming weeks as this kind of plays out. I think the silver lining is that the government, lenders, borrowers, landlords seem to be in this sort of forgiving, let's get through this together and mindset, and that can help for a certain amount of time, and then reality could sit in. So hopefully the numbers get better in terms of the rate of new infections, and you know, in the meantime, there's this collaborative environment and now liquidity in the market from the government that hopefully gets us through it. The exact when is really difficult to tell right now because there's just some unknowns for everyone.
What is the level of new activity with new opportunities that you're seeing? But then to tie that together, if you have money right now, what would you be doing with it?
I'll answer, and then the Ben and Jake can answer as well. I think most people right now, in the immediate term, call it the next 30 days, they're dealing with current issues. They're not really looking for a lot of new opportunities. Lenders aren't doing a ton of new loans, but they're working with their borrowers on loans. I think nobody's going out and signing. Anyone who's got like a live lease, from what I understand, is getting retraded. If you've got dry powder, most people feel like it's too early to transact, but you should be having the conversations and getting an understanding of what the opportunities are going to be. Wouldn't be surprised to see some debt change hands at a discount. Lenders just not necessarily being set up to deal with this uncertainty or loans requiring special service or so on. So you could see some of that happening. So if you're a landlord, you might find a situation to pay down your loan at a discount, for example. That might be an opportunity. I don't know, Ben and Jake, you guys have some other thoughts on that?
Yeah, I would say that, real estate in general is kind of a lagging indicator in such that it takes a little while for things to process through the system. And so to Gary's point, it takes a little bit longer for people to want to start transacting again. I think there's going to be a big opportunity. You've seen, while real estate is a lagging indicator, we have some publicly traded real estate companies that kind of act as potentially a barometer for what the market might do. And, I think in our space in particular, there are a few publicly traded triple net REITs that have suffered tremendously. And I think you're going to see them pull back a lot in their new acquisitions as they focus on the asset management that the lenders and other landlords are dealing with as well. And so I think there'll be kind of a little bit of a void in the market from your big institutional buyers that particularly are publicly traded that have reporting requirements. And so I think that's going to create an opportunity for some people to purchase real estate that otherwise would have been bought out by those larger guys.
Yeah, I think immediate distress has gotten a little bit of relief by what the government's doing. But one would think that would be where if a tenant's going to go out of business, that real estate's worth a lot less for a much longer time than a tenant that's got a viable business that's just vulnerable to what's going on right now, but will come through on the other end. The value of that real estate, maybe cap rates change as a result of this, because everyone's going to there'll be a flight to quality, and so if you don't have an A asset with an A tenant, the cap rates might go up, but the immediate opportunities would be where something is no longer viable, or someone's in a position where they have to sell, or a lender has to transact. Anyone who doesn't have to do anything probably won't do anything over the next 90 days.
How do y'all see the interest rates being impacted over all this?
From the interest rate perspective, not a great answer in that it changes day by day. It kind of separating out the lenders that are still and still not offering debt. I'd say on the private side with specifically debt funds, we're kind of the first to put the brakes on. Additionally, equity groups on kind of live transactions were the first ones to start pulling back when this all started unfolding. CMBS right now is kind of completely halted, so that's not really an option for capital. I'd say from the banking side, until really last week, they were still fairly full steam ahead, business as usual, but this week we're really starting to hear that banks, even with existing clients, are putting the brakes on, and also really except for gold-plated opportunities with existing lenders, just stopping activity for the number that we've heard a lot is 2 weeks. Leaving life companies who, interestingly enough, are still lending, but a lot of them have kind of floors right now of 4 and 5%, high 4 and 5% due to an internal allocation of their funds towards the corporate bonds, which are now yielding 4 and 5%, which were previously substantially below that. So life companies in particular are kind of taking advantage of the spread in that market and diverting funds away from real estate. All to say, really, if you're looking for a loan right now, your options are true hard money groups, which are going to be extremely high, 10+% interest rates. Or if you happen to have a deal that is kind of a sweetheart and fits the banking box exactly, you still will get a bank rate, which in this environment could be in the mid-3s, to put a number on it. But there's just a very small box for deals that banks will transact on. It's almost, banks and other groups typically quote on a spread to an index, and everything today is just in terms of a fixed coupon. And that number really just varies tremendously, as I mentioned, day to day, and it really, it depends, is kind of the answer.
I think another interesting point too is it kind of relates to any client's kind of bigger macroeconomic thoughts about where interest rates are going to go. When interest rates fall the way that they have, the floating rate deals all of a sudden look really a lot more attractive than they did a while ago when LIBOR was 2%. One of the things that people didn't really negotiate 6 to 12, 18 months ago was LIBOR floors. And now all of a sudden those LIBOR floors are becoming one of the most valuable pieces of your financing. And they're worth a lot more than they, cost to negotiate early on. So, that's one thing that's playing into it, is that when you have these lower interest rates and people are able to benefit from those lower interest rates, you might get the benefit of cap rates coming down to match them. Alternatively, on the other side of things, you have less people providing capital. And so that's pushing the cap rates up. And so there's some interesting push-pull dynamics that are going on with interest rates that it's difficult to say where they're going to land. More so than ever, I think that relationships with lenders and brokers and whatever it may be really come into play during times like this when there's a lot of uncertainty, and taking the opportunity that's on the table is potentially the best opportunity, because you don't know how long it's going to be there. So if there's somebody that you're comfortable executing with, whether it's making an acquisition or selling a property or financing your property, during uncertain times like this, it probably makes sense to take the bird in the hand.
It's like it's head spinning,
Yeah.
And I was talking to someone of fairly wealthy investor in Beverly Hills this morning. He owns, I sold him bunch of Bob Evans with some really cheap rents, like cheap, as in $50,000 a piece. It was 3 of them, sold them for like 5 caps, said they were just $1 million a piece. They are not paying their rent. And he's like, and it's like 5% rent to sales ratio approximately. So it's like, okay, you're still selling food. There's some frustrations out there. So he understands that, and he's willing to be flexible, but he understands that his rent is only a piece of the puzzle. So are they renegotiating food costs? Are you talking to, obviously, the municipalities with regards to your taxes? He's just, this guy sitting in California is just one piece of the puzzle. So there's a lot of variables at play, and people are just a little, annoyed. He owns an LA Fitness. They're not open for business at all, so they're not paying their rent. That makes sense. But if you're a restaurant, and maybe, I was talking to a Burger King guy today, they were doing 60 up to 70% of their business was drive-through. That number actually has gone up, although their overall number has gone down because kids aren't in school, so they're not going there for lunch. And, there's just not people out and about. So their overall sales have dropped 30%, but they're not out of business. Their business is just greatly impacted.
Are they asking for rent concessions?
Oh yeah.
Yeah.
And
But that Bob Evans one is a tough one because it's a difficult environment to be tough on your tenants. That one is one worth some more thought. I don't know if there's an easy answer to that one. It's a difficult environment, and I think some tenants are going to take advantage of that, where they don't necessarily need to or should.
yeah, you're going to see that. I think attorneys or in-house counsel and CFOs are busy drafting these letters, as carpet bombing them and seeing what sticks, because they know that there's unsophisticated investors, kind of similar to the 1031 guys we deal with. They're absentee, they're several states away. They want to do the right thing. They don't want to get taken advantage of. They want the lights to stay on. It's just mixed. A lot of different, everything that we're talking about has all these different storylines, and no two are alike.
Yeah, I think the big picture mindset for landlords or anyone in this environment is play for the long game, and I think if you think this is a 3 to 6 month problem, what do you for tenants that are viable, right? There are going to be some tenants that aren't going to make it through this.
Sure.
Whether they were going to make it through the next 3 years, and now that got accelerated. But if you have tenants that are going to make it, play for the long ball. And I think the decisions should be made not to be too much. I've talked to a friend of mine who owns a lot of retail, and he's a real hard-nosed guy. And I'd be curious, I talked to him a couple weeks ago, how much his mindset has changed. Because we're just in an environment where it's going to take a few months at least to get through it. There'll be some permanent damage, but some people will come out and they'll be fine. And you wouldn't want to have sunk a tenant or a relationship that would have made it.
Absolutely. Good points.
Thank you guys for taking your time out of your day to do this. I know we have a lot going on. It's pretty hectic right now, but I think it's important to stay calm and be as professional and give sound advice, even though things are kind of up in the air. But definitely appreciate all the insight you guys have given.
Thank you. Thanks for having us.
Thanks, guys.
Of course.